23 seconds away from the opening bell this morning. Good morning to you. Equity futures negative 0.5% on the S&P. On the Nasdaq down 0.5%. Also a rally, a lift off the back of Chairman Powell's comments yesterday. Just retreating just a little bit right now as we get some comments from the New York Fed President John Williams. I'll get to those comments right now. There's your opening bell. Switch at the board and look at the bond market. Yields look like this. They're coming about a basis point on the US 10-year. John Williams speaking at a Wall Street Journal event right now and saying the following. 25 basis point increases seem like the right size. If the situation changes, we can move faster than 25 basis points. A peak rate of 5% to 5.25, still a reasonable view. There is a lot of uncertainty around the inflation outlook. We'll pick up on those comments in just a moment. Euro dollar, the big range of the last week from 110 down to 106 and right now 107.31. We're going absolutely nowhere. On crude at 1% to about $78.13. 30 seconds into the session, we retreat by 0.4% on the S&P. On the Nasdaq, we're down about 0.4%. Also, the sector to watch at the open, it's tech. eBay and Zoom becoming the latest tech firms to slash their workforce. eBay blaming its 4% cut on economic forecasts. The CEO saying they are necessary to, quote, create long-term sustainable growth. Abby has more. Hey, Abby.
Hey, John. Well, this story goes on. We've had so many tech companies laying people off recently, and there seems to be two main reasons. One, it has to do with overhiring in the pandemic, or two, more what eBay is talking about, tougher trends. So in the former category, think of Salesforce.com, Microsoft, Alphabet, Amazon, and so on. In the latter, think about Dell, where they're talking about those difficult trends. So eBay has seen their sales decline, so they are having a more difficult fundamental background. So they're dealing with it with these job cuts. They are cutting they're cutting a number of people, 4% of their global workforce, or about 500 people. This as sales started declining in the first quarter of last year, down 6%. For this current quarter we're in, down 5%. So clearly they want to see that change. It's interesting, though, because you would think that the workforce reductions would target more the margin situation, but nonetheless, that's one strategy that they are taking. Now, relative to Zoom, it seems to be a little bit of both. They're cutting 1,300 jobs, or about 15% of their workforce, returning to 2021 levels, as you and Kaylee have been talking about. It's just extraordinary. They tripled their workforce to 8,400 people between 2019 and October of last year. Now they're paring it back, but they're also seeing a reduction of use coming out of the pandemic. What's so interesting about the stock, though, John, is it's down 86% from the pandemic boom, but it's still more than a double from the IPO. So I'm guessing that they are trying to preserve some of that stock growth for sure.
Abby, thank you. Those comments keep coming through from the New York Fed President John Williams, who says he broadly sees financial conditions as being tightening a lot in the past year. Now, this, of course, depends on what time period you look at and what you look at to establish what financial conditions are doing. Now, if you just take markets over the last few months, let's go year to date on the Nasdaq, up 16%. Take the dollar, which peaked at the end of September, negative about 10%. Look at credit spreads from the wide to last year. High yield tightened by 200 basis points. Have they tightened a lot over the last 3-4 months? That would be the pushback, but their time period seems to be over the last year. Bit of confusion around this. Mike McKee going to talk about it in about 15 minutes. I'm looking forward to that conversation. Just to return to the price action of the moment, about 3 minutes in, we're negative 0.5% on the S&P. On the Nasdaq, we're down 0.6%. Yields basically unchanged now at the front end. The 2-year 4.46, on a 10-year 3.67. I want to stick with tech. Microsoft rallying for a second day after unveiling its new AI software, a search engine using ChatGPT to compete with the likes of Google and Baidu. The CEO, Satya Nadella, said this technology is going to reshape pretty much every software category. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. It's the new frontier, the new big thing, and it seems we can't go a day without talking about AI and investors getting excited about AI, which arguably is why Microsoft is positive on the day, even though we did get some arguably bad regulatory news out of the UK with the CMA taking issue with their $69 billion deal to buy Activision because they say it'll harm competition in the UK gaming market. That's why Activision is lower by about 2.4%. But back to the AI thing, this is really about making Bing and Edge more competitive. And I know some of you out there are asking, is Bing even still a thing? It has really struggled to gain traction against competitors like Google, but that is what these new products with the ChatGPT software and the billions of dollars in investment into OpenAI are trying to accomplish. The new Bing can be switched in and out of chat mode. The new Edge browser adds the AI-based Bing for chat and writing text. It can summarize web pages, respond conversationally. to queries, and investors and analysts, the sell side today, seem to be into it. So that is what is adding to the gains Microsoft has already seen this year. It's already seen more than $200 billion in market value added, and this is part of a broader big tech rally we have seen in 2023. When you add it all up among those 6 large stocks we have here, $1.4 trillion worth of value gains in just over a month period, even though earnings arguably haven't been that great. And of course for Nvidia there, which has had about $185 billion added in value, that is also an AI play, John. A lot of it comes back to this.
Kaylee, thank you. Here's the line from Williams. If financial conditions loosen, more higher rates may be needed. Fairly intuitive, but certainly not what we heard much from Chairman Powell over the last week or so. Again, Mike McKee's going to drop by the studio and we'll talk about this. So you Google, you don't Bing, and you Uber, you don't Lyft. Uber this morning beating analyst estimates with ridership and driver base hitting an all-time high. We ended 22 with our strongest quarter ever with robust demand and record margins. The pandemic's impact on our mobility business is now well and truly behind us. Mandeep Singh, this stock is flying.
Look, I think when you look at the print, obviously there's a lot to like here, but the most notable thing for me is they're able to grow supply in the marketplace by about 35%. Now, what that tells me is not only is inflation a tailwind for their business on the pricing side, but it's also helping them on the supply side, because remember, a lot of people are looking to supplement their income, and Uber seems to be that place where they can do that. And that's why I feel like with any marketplace, if you see supply growing in line with top line, that's a very healthy sign. And also they've improved their execution in terms of cutting costs, the incremental margins are going up. And finally, you're seeing some synergies between their ride sharing and delivery, which is their Uber One subscription. So a lot to like in that print. The one more thing I would call out is their ad business. They said it's a $500 million run rate. Now, that is, even though it's a side thing for a company of Uber size, over $30 billion in revenue, but still it's a very high margin business. So I think that's why you see that, optimism around
Mandeep, at times we used to talk about streaming and say there could only be one winner. Who would it be? Maybe it would be Netflix. In this space, when you see the success of Uber in this quarter, is it at the expense of Lyft?
To an extent, I would say it will come at the expense of the smaller players, and not just Lyft. I mean, this market is so fragmented. For the last 2-3 years, you had got a lot of niche players, and look, there are certain players that have carved out, scale. For example, Instacart on the grocery delivery side, but DoorDash on the food delivery side. But still, I feel like Uber with its scale and on the supply side, I think that's going to be a big advantage and something to watch out for. I mean, one data point doesn't make a trend, but clearly they seem to be executing very well on the supply front.
I'm just looking at the year-to-date performance, and Mandeep Singh, thank you, sir, from Bloomberg Intelligence. Uber's up almost 50% year-to-date. DoorDash up 31%. Lyft is up 63% year-to-date. These names have been flying. But a broader market, 7 or 8 minutes into the session, equities are lower by 1/3 of 1%, just about off the lows. Early days on the Nasdaq down by 0.4 of 1%. Bank of America's Jill Carey Hall sounded the alarm on big US multinationals, writing the following: cyclical and secular challenges face the sector, this is tech, amid the reversal in 10 years of free money, a pause in globalization and a massive COVID demand pull forward. Jill, I'm pleased to say, joins us right now. So Jill, you guys have written about this, so talk to me about it. The globalization beneficiaries of the last decade or so, do you think there needs to be some kind of valuation for multinationals to de-rate?
Well, I think you've seen, as you said, many decades where S&P 500 companies' margins have expanded on a secular basis, and globalization was a really big driver of that. Lower costs from offshoring, lower labor costs, lower taxes overseas, and we were in a backdrop where tech and growth stocks were the leadership, and we think that in the next cycle we could see some new leadership. Many of these stocks benefited from free money, zero interest rate policy. They saw that secular expansion in their margins. And even after the recent layoffs, we're still seeing that, labor is still bloated relative to sales growth at many of these companies. So, earnings have missed for tech this quarter. We've seen NASDAQ earnings come down relative to S&P 500 earnings, where after, many decades, the opposite was true. So, we see challenges for tech going forward. It is a cyclical sector. We saw a lot of demand pull forward during COVID, but it is a sector that tends to be more cyclical during recessions. And we think if we do go into a recession this year, which our economists are expecting a mild one, this could prove to be a more cyclical sector.
Jill, a couple of points there. Let's pick up on the first one. Earnings have missed, but the stocks have rallied. Jill, can you explain why?
Look, I think there was a big, positioning and sentiment-driven rally this year. We had pointed out late last year that sentiment had gotten very negative on the market for the first half. And as we moved into January, we saw that kind of positioning reversal. If you look at what sectors have done well this year, it's been, kind of the exact reversal of what did well last year. And, many of the sectors that won last year have done poorly this year. So, some of the misses this earnings season have been underperforming. There's obviously also been optimism around, China reopening, potential for soft landing in the U.S. So, we think those have been some of the drivers of the rally in January and year to date.
Can I pick up on that point, Jill? I think it's a really important one. Your point as a team pushing back against maybe the valuations of multinationals. How do you pair that with the thirst, the hunger right now to get exposure to a better international story off the back of China reopening?
Sure. Well, I think, the multinationals will certainly have some tailwinds in terms of the global economic backdrop in China reopening, in terms of, just if the dollar, we see some reversals there. But overall, I think they've benefited from some of these trends that we've been talking about for many decades. And, on China reopening specifically, obviously some areas like materials and commodities have rallied on the China reopening expectations. We think the recovery there will be more consumption-led, so perhaps some different beneficiaries than the typical China recovery story.
Clearly, the overwhelming feature of some of the research for you guys over the last few months, Jill, has been the margin pressure. Is there a shelter from some of those themes? Where do you find that shelter?
Yeah, so I think so. We're definitely seeing cross currents within the margin backdrop. So, no question we think earnings and margin expectations for the overall market have been too lofty. We do expect earnings estimates to come down further this year, even after the large amount they've been slashed heading into this earnings season. We're looking for a 9% decline in earnings year over year, which is about half of the typical earnings decline you'd see in a recession, given our expectations that if we do see one, it'll be mild. Consensus is still looking for slightly positive growth. But I think there are, a number of companies and sectors within the market that, could see some margin benefits this year. Areas like some of the consumer staples or home builders where you're seeing, lumber prices or many of the input costs reverse. So we think this year is definitely going to be less about macro, more about cross currents in the market, and it's going to be a good environment for, picking stocks and sectors, active management.
I want to finish on this line here from you, because I teased it. Risky sectors are safe, safe sectors are risky. Help us all understand that, Jill.
Sure. I think, when you look at sectors like tech, they've actually seen their beta go up, and tech is one of the higher beta sectors, whereas if you look at some of the sectors that are traditionally riskier, higher beta sectors like financials and energy, they've actually seen their betas decline a lot over the last year and enter some of the now lower beta sectors. So I think, risk profiles of some sectors have changed. We've seen that within small caps as well. Small cap healthcare is one of the areas within small caps that I've been relatively more cautious on. Typically, you want to own healthcare in a recession, but healthcare in small caps has deteriorated dramatically in quality. 60% of that sector in small caps is non-earning stocks. So I think there are some shifts we've seen in sectors that, the typical recessionary playbook may not necessarily apply, where, financials looks a lot more like a high quality sector relative to how it looked going into the financial crisis. Energy companies are much more disciplined now. They're morphing into free cash flow generating companies. So we're definitely seeing a lot of shifts in sector risk profiles.
Hey, Jill, I've really enjoyed reading the research, particularly over the last month or so to start the year. Jill Carey-Hill there of Bank of America, alongside Savita Subramanian, putting out some brilliant equity research in the last couple of months. Want to get you a few more headlines. Alphabet, Katie Lyons, you talked about Microsoft. Alphabet getting hammered in early trading.
Yeah, we're down about 5.5% right now, so just off of session lows, but could be the worst day for the stock in some time. And this is about this AI competition and race to introduce these products. We were just talking about Microsoft making the investment into OpenAI. Google is also trying to do this with its own search engine. with their AI chatbot Bard, but Reuters is actually reporting this morning that in an online advertisement for Bard, it was delivering inaccurate answers, which maybe is why we are seeing such a down move for the stock right now, considering everyone seems to be rushing to put out this technology. If it is inaccurate technology, obviously that puts you at a competitive disadvantage at a time when Microsoft is ramping this up, Baidu is ramping this up. We're seeing millions and millions of dollars in funding going to various startups in this space. It's a race, John, and right now Alphabet doesn't look like they're out front.
The spread between those two stories, those two names right now, fascinating. Katie,
Yeah.
Thank you. Microsoft up by 3%, Alphabet down by about 5%. Coming up, Fed speak, pick it up following last week's decision.
We're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time.
We'll get you the latest comments from the New York Fed President, John Williams, with Mike McKee. Up next.
We're just at the beginning of this process. The disinflationary process, the process of getting inflation down, has begun. It has a long way to go. These are the very early stages of disinflation. It's not going to be, we don't think, smooth. It's probably going to be bumpy. This process is likely to take quite a bit of time. My guess is it will take certainly into not just this year, but next year to get down close to 2%. We think that we're going to need to do further rate increases, keep rates at a restrictive level for a period of time. The base case case is for me is that it will take some time, and we'll have to do more rate increases, and then we'll have to look around and see whether we've done enough.
Chairman Powell, for the most part, sticking to script yesterday, setting the stage for a busy week of Fed speak. New York Fed President John Williams speaking right now, saying moments ago, we still have work to do. If financial conditions loosen, higher rates may be needed. And going on to say this, Mike, just a moment ago, putting a timeline on a period of time, maintain restrictive stance for a few years. That coming in just moments ago.
Yeah, a restrictive stance, though, might be lower than 5.25%. He did say that he still thinks that a 5.25%, what the Fed thought they would be at when they did their last dot plot in December, is still a reasonable view. And he came back saying, basically, as Jay Powell did, still have our work cut out for us. We are barely into restrictive at this point, and a 25 basis point increase seems like the right size. And then adding, as you just mentioned, that looser financial conditions might imply they have to go higher than 5.25% if inflation remains sticky. And that's the big question is they don't know exactly what's going to happen. And Williams is basically saying we're data dependent. We're going to follow what the data are telling us. And that might mean we go higher. That might mean we stop at 5.25%. But he did suggest it's going to stay there for a while, which is the base case message from the Fed. And it seems like the markets are finally listening. When you look at the yield curve over the last week, from last Wednesday, that's the line on the bottom, to today, the white line, you can see that markets have priced in higher rate level all across the curve. And
yep.
It does appear that maybe they got the message. You did mention there's a lot of Fed speak out there today. Barr, Bostic, Kashkari, and Waller yet to come.
Can't wait.
And we have Lisa Cook speaking now, although nothing's hit the wire from her yet. So I guess basically we could have simplified this and just handed out a piece of paper to all of them to come out and say, yeah, what he said, that Powell guy.
What she said, what he said, and what they all said. Mike, I want to finish on this. There's been some pushback around financial conditions. All of this depends on how you measure financial conditions and over what time period. John Williams moments ago said financial conditions broadly have tightened a lot in a past year. Mike, the chairman took some criticism on Wednesday when he made similar comments in the news conference. Where are you on this debate?
Well, as you say, it depends on the time horizon. If you look at financial conditions from the time the Fed started raising rates in March of 2022, then yes, they've tightened significantly. Over the past 3 or 4 months, they have come down. It just depends on whether you think financial conditions are slowing the economy enough, slowing inflation enough. And at this point, the Fed isn't sure. Even though they've come down, we have seen inflation come down. So they're going to keep an eye on this. And of course, next Wednesday, we've got the CPI.
Mike, there's a feeling they don't care about the equity market in maybe the same way they did in the summer. Would that be the correct read?
Or for the last couple of years, yeah. It's like mom used to like me, but she doesn't anymore. The Fed is.
Are you talking about equity market bears being
the
looking
Fed
up to
has got
Chairman
a
Powell's
credibility
mom?
question, and they say they need to keep rates high long enough to keep the inflation rate going down. It's been a long time since they had to do that, and people on Wall Street weren't around then, and so now it's going to be a test of wills. Who can go longer, the Fed or the markets, hoping for a Fed put.
Mike, thank you. As always, appreciate it. About 22 minutes into the session, we're lower by 0.5% on the S&P and the Nasdaq down by 0.6%. Just to lift the lid on the index and break it down sector to sector is Abby.
John, very interesting sector action today, only because of the decline that we're seeing right now, relatively modest, yet most sectors for the S&P 500 lower, some of them significantly. Communication services in particular down 3.2% on that Alphabet fall that you and Kelly were talking about on the AI competition. We also have utilities, consumer discretionary, staples and industrials down there. So lots of defense down. On the year, though, take a look at these travel sectors, airlines, hotels, railroads, and there's Uber, as you were talking about, up 44% this year.
Abby, thank you. That's your sector price action. The broader index down 0.4% on the S&P. Your trading diary up next. Close to 26 minutes into the session, equities taking a little bite out of a big year-to-date gain on the S&P and on the Nasdaq too. Equities right now down about 0.5% on the S&P, still up on the year by about 8%. On the Nasdaq, close to 16 percentage points higher, lower on the session by 0.8%. That's the price action. Here's the trading diary. Coming up, Fed speak, Barr, Bostic, Kashkari, Waller, all on deck. Cook talking right now. President Biden discussing the U.S. economy at 2 p.m. Eastern time. We get earnings after the bell from Disney, another round of jobless claims tomorrow morning, and we end the week with a UMich sentiment survey to close out Friday and get straight into the weekend. Live from New York, that is it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Great questions from the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, February 8th. Here are the top market stories we're following for you at this hour. Fighting for the driver's seat. Powell signals higher rates for longer, while equity markets just refuse to budge. We try to figure out who's in charge. And rideshare to profits. Uber beats estimates. Stock is up 3%. Analysts calling it a clean beat. We're going to sit down with the CEO. And the most misunderstood stock. Barclays says BP is worth a lot more and likes its free cash flow potential. We're going to sit down for an exclusive interview with Bernard Looney of BP. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guys, sure, we're a little lighter here. We got NASDAQ 100 out by 0.7, but it doesn't feel like it's in relation to the hawkish talk we are still getting from Powell and Fed officials like Williams and Cook this morning.
Yeah, Google's down pretty hard, but I think that is a Microsoft-specific issue.
Sure.
It's really interesting. I think we probably could have linked Uber and driving seat, but we'll park that one for the moment.
I totally tried to. Did that not come across?
Okay. I think I could see where you were going with it. Let's talk a little bit about Powell. Maybe Powell doesn't care. Powell maybe he's just taking the view, I'm in the driving seat. You may think you're in the driving seat, but ultimately I've got time on my hands. So yeah, you may be not getting the message quite right now, but you'll get it eventually. And I'm just going to wait.
Yeah, it reminds me a little bit about a parent dealing with a child. Like, is Powell the parent and the market's the children that are having a tantrum, and the parent just decides, you know what, you go freak out in a corner, I'm going to sit here. When you're done freaking out, I'll be here. It reminded me a little bit of that yesterday.
Yeah, my parenting skills are obviously a lot worse than your parenting skills because sitting in the corner while my child has a tantrum was not something I never really managed to achieve. But maybe Powell can. Maybe that is exactly what is happening here. So our question of the day, and driving is going to be a theme throughout this entire program, is who is driving, Powell or the markets? Let's bring in the crew we had yesterday to try and continue our analysis. Bloomberg's international economics and policy correspondent, who is of course Mike McKee, and Ira Jersey, Bloomberg Intelligence's chief US rates strategist. Ira, let me come to you first of all on this one, because you kind of represent the market here. Who's in charge of this narrative? Is it the markets or is it the Fed?
Well, the Fed's trying to take the narrative, but the market's winning, and the market will always win, right? At the end of the day, the market is going to price what it sees as the likely outcomes, and it's not going to. I don't think the Fed's going to be bullied into doing something one way or the other by the market, but I do think that that the market has a different view on what the likely outcomes are than Federal Reserve speakers, even those that have been speaking just the last hour with both President Williams and Governor Cook, on the tape, saying that they're going to have to keep rates high for longer, which is very consistent with what Jay Powell said the last 2 weeks.
First of all, Ira, the suspenders, definitely amazing. I just want to point that out there. Mike, to that point, though, isn't the whole reason for living for the Fed is to eventually tighten financial conditions? Like, isn't that the transmission mechanism that the Fed has to the real economy? And if it's not happening, is their policy working?
Well, they're arguing that their policy is working because financial conditions did tighten from the time that they started raising rates. They came down a little bit in recent months. But you look over the past week and you look at what's happened to the yield curve, markets are starting to at least come in the Fed's direction. We've seen a move higher over the past week in terms of where at least the bond market is pricing. I'm not going to comment on equities, but I think I would take the opposite side of the argument from Ira and say the Fed will win because the Fed has to win. The Fed has to follow through, or else it's going to be led around by the nose forever. And they know they have been in recent years. So they're all arguing at this point that we are going to keep rates higher for longer. I kind of would change the analogy of driving the car to something I think we can all relate to. All four of us have probably said at one time or another, because I'm the parent, that's why.
Yeah.
I can't disagree with that. I can't disagree with that actually, because the Fed's going to win, right? The Fed is going to, I think, keep interest rates, basically at whatever the peak ends up being for the next year or so, and that's not something that the market's currently pricing, although it's pricing a little less in terms of cuts this year than it was before. But at the end of the day, the market is, the market is going to move in what it thinks the Fed's going to do, and the market always thinks that it's smarter than the Fed, and quite frankly, both are terrible at forecasting. So at the end of the day, the Fed's still going to do what it's going to do, and the market's going to have to adjust to whatever outcomes that is.
Well, there is a third option here. We've only kind of allowed for two in terms of the driving side of things, so we're going to go back to that. I appreciate Mike's foray into parenting, but nevertheless, it's the data that's in the driving seat, isn't it, Mike?
Absolutely. People were saying yesterday, why didn't Jay Powell come out and say, we're going to have to raise rates higher than we initially thought? That would have been pushing back. But they have another employment report, and they have two CPI reports and a PCE inflation report before their next meeting on March 22nd, let alone a couple of retail sales numbers. So at this point, the data are going to determine between now and then whether they think they need to go higher or not. There's no percentage in it for Powell to say higher right now and then to have to back off if the data show that they are having more success. So watch those numbers on Bloomberg TV, 8:30 in the mornings and 10 a.m. Eastern time.
Promo, dude. You don't need to do that. Ira, is the word disinflation, though, a word that Powell should stop using?
Well, I totally think that that's what's confusing the market, and certainly seems to have confused some of the algorithms, some of the computer programs, because the use of the word disinflation, I think, was taken to mean something that Jay Powell and other members of the Federal Reserve, hadn't intended, and that's that, inflation is moving significantly lower than than the market seems to think that it's going to. And in fairness, the market still thinks that we're going to have very low inflation by the end of this year. Year-over-year inflation is still priced to be under 3% by the end of 2023. And because of that, that's one reason why the market continues to have this downward glide path for rates, even in the near term. Like longer term, I think it makes sense because at some point we'll have a recession and we'll probably have a little bit of deflation in that. So it makes sense for the yield curve to be inverted pretty significantly, but maybe it's not inverted enough, right? Given the potential outcome that the Fed, if Mike's right, and the Federal Reserve is the parent and wins, then 2-year yields might be as high as 4.8%. We put out a note this morning noting that if the Federal Reserve stays on hold for as long as Bloomberg Economics thinks it will, then right now we should be at 4.8% on 2-year yields, which is, that's still a pretty significant move from where we are right now.
And that's the point, isn't it, Mike, that the Fed can get to a reasonably elevated level, and I'm not sure 525 or 550 or ultimately what it ends up being makes much difference. It's the time that we spend there. And I'm wondering if that is the kind of shock absorber here for the Fed. It's just, we're going to get there and then we're going to stay there. And that, again, the market is not latching onto. The market anticipates cuts, but the market's operating on a kind of here and now basis, whilst the Fed is operating on a kind of 1-year long and variable lags basis.
Yeah, exactly. The market is thinking in terms of what happens next. They're trying to game out what the Fed is going to be doing when the Fed itself doesn't know. So the Fed is going into this, and they are pretty much all saying, Lisa Cook is on the wires now saying, we got to keep rates higher for longer. They're all saying the same thing, that we're going to raise to a certain level where we think we are restrictive, which in their minds is around this 5.25%, and then we're going to leave it there and let the accumulated weight of the tightening bring the economy to a slower speed, which in theory will bring inflation down. Now, Powell has said, and he said at the news conference and he said yesterday, well, if inflation comes down much faster than we think, then maybe we change our policy. But right now they're operating under the view that we keep it up there until we get what we want. And the markets think, I guess, they're going to get what they want, and so they're pricing in a reaction to that.
So does that mean that we're still looking at a soft landing? Like, is that a reality that the Fed really thinks is going to happen?
Well, I don't think they
they want it.
Yeah, I don't think they would say they think it's really going to happen. They think it's a possibility, and maybe a little bit more of a possibility, because if we see the same pattern as Friday, where we have reasonably strong job growth, now not 500,000 a month, but reasonably strong job growth, and wages that are decelerating rather than accelerating, then that raises the possibility of a soft landing, which doesn't really have a definition, but I think it's one of those things we will know it when we see it. And they have to, at the same time, have inflation come down to meet that. So if they do those two things, maybe by the end of the year, we do see them say, okay, we can cut rates.
I know there's a driving reference here at some point to wrap this convo up, but I don't know if I have it, but I'm going to think about it. All right, guys, thanks a lot. We really appreciate it. Mike, Ira, love the suspenders. Thank you both very much. Some breaking news for you. Got Google down, Alphabet, pardon me, down over 6%. It's the biggest intraday drop we've seen since October. You got Google's newly launched AI chatbot called Bard is looking at inaccurate responses, and that is really weighing on the stock. This is as we've seen a lot of these names like Microsoft and Google bid up because of this AI chatbot GPT race. We're going to get more on this in just a moment. Coming up, back to the question of the day, who is driving the Fed or the markets, and what do you do if you actually have to put money to work? Maria Vasilou of Goldman Sachs Asset Management will be joining us next. This is Bloomberg.
Inflation season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The market is now repriced to basically mimic what the Fed has written down in their December summary of economic projections. The market is now pricing in a 25 basis point rate hike in March and a 25 basis point rate hike in May. That's what Fed officials have been promising, so we're pretty much in alignment now.
Now, as former New York Fed president and Bloomberg opinion columnist Bill Dudley earlier on Bloomberg TV, which brings us to the question of the day: who's driving, Powell or the markets? Joining us now for her take, Maria Vasilou, co-CIO of Multi-Asset Solutions over at Goldman Sachs Asset Management. Maria, your take: who's driving?
Certainly not the Fed at the moment, but we have to be very careful in interpreting what Chair Powell is saying. We have to keep in mind that we are in a pre-election period for the presidential elections. This is a Fed chairman who was appointed by a Republican administration and serving under a Democratic administration. He certainly wants to stay above the political fray, and it's indicative how careful he was in phrasing his remarks about the debt ceiling. But I think the market is hearing what the market wants to hear, and he did say their job is not going to be done until they get firmly back to 2%. He did say they're going to keep hiking rates as long as they need to, and he did say that they need to loosen up the labor market. So I don't think he has said anything to indicate that he's not going to get the job done.
I'm going to give the bond market a pass here because we've just been hearing from Bill Dudley. We are starting to now reprice towards where the Fed is, Maria. Good to see you, by the way. What I'm wondering about is the equity market. The equity market is looking at an incredibly strong labor market, which is going to encourage the Fed to go further. It's also going to dent margins in a pretty big way because companies are going to have to hang on to and pay their staff more. Yet the equity market has risen aggressively. Why is the equity market getting or receiving a different message that maybe is being sent out or the one that's being received by the bond market?
I think the equity market is pricing a way too optimistic scenario, and we're probably poised for a correction at some point. I think the fact that the labor market is strong does not necessarily, in my view, increases the probability of a soft landing. It increases the probability of further hikes by the Fed. So Chair Powell has been very clear in pointing out that the problem with the CPI is in the core services, which are directly dependent on consumer demand and consumer strength. And so given the recent labor market data, it means that in order to create disinflation in the services sector, he needs to loosen up the labor market. So there is more pain ahead.
Yeah, and as guys been pointing out all morning, used car prices are jumping, so inflation can come back. So does that mean that you need to de-risk on a risk day?
I think we had our year in January. From now on, I would focus mostly on generating alpha and being hedged in terms of beta, in looking at active management. There are a lot of dislocations out there in the equity markets, but also in the credit markets. But calling the beta at this point is going to be really hard going forward.
So what do you do? How do you position, Maria? How should you be positioned right now?
We are positioned slightly underweight equities, but in a way that we are actually making money through alpha and through active management. So we think that this is the name of the game going forward. Active management, focusing on asymmetric payoff trades through relative value trades, trying to protect the downside, and really leaning into the dislocations that have occurred in the market.
Which ones? Where's the best?
Well, we have, across the different sectors, we had companies that have been hit way too hard compared to...
Are you talking about tech right now?
Including tech, but also in other areas. We're focused on quality stocks, on good operators. We're focused on defensive areas. Commodities could be a great place to be. Consumer staples could be another good place to be. But certainly things that would do well in a slowdown. We do...
Why do you, Maria, why do you want to be in consumer staples when the consumer still seems to be doing really well? The consumer still seems to be wanting to spend money. The consumer still seems to want to go on holiday, vacation. The consumer does want to buy discretionary items and has a job maybe to back up the purchases of those discretionary items. Why do you want to go the other way?
Because going forward, we expect the Fed to continue hiking. That eventually is going to have a bigger effect on earnings and profit margins. We do expect the labor market to loosen up. We can't see how we're going to go back to 2% inflation without a significant loosening up of the labor market. And consumer staples have inelastic demand, so these are the ones that would do better going forward.
Maria, always love your insight. Thank you so very much. Maria Vasiliu of Goldman Sachs Asset Management. Oh wait, that was you, Guy. Were you supposed to tag there?
I can do that, but you
it's
seem
me
to
now.
have done it brilliantly. You were sitting next to. I feel it was only appropriate that you should have thanks. Used car prices. I'm telling you, keep an eye on Carvana.
You're on that.
I know it's a new stock, and I know that it's bouncing around all over the place, but yeah.
Me? I'll go.
You can go.
Still
now.
ahead. Consumers are still ordering takeout and hailing rides despite inflation. It's all about driving out Uber shares, getting a lift from its strongest ever quarter. We're going to get more on the startup next. This is Bloomberg. It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The pharmacy giant CVS is pushing deeper into healthcare. The chain has agreed to buy Oak Street Health in an all-cash transaction with an enterprise value of about $10.6 billion. Oak Street aims to reinvent care for Medicare patients with low incomes and chronic health problems. CVS says the deal will increase healthcare access in underserved communities.
Uber posted fourth quarter revenue that beat estimates. That suggests rising inflation hasn't kept consumers from hailing a ride or ordering more takeout. Uber's revenue soared 49% in the last 3 months of the year. And LeBron James has a lot of titles now. He has a new one, all-time leading scorer in the NBA. Last night, the Lakers star surpassed the mark of 38,387 points set by Kareem Abdul-Jabbar. James has another impressive accomplishment. According to the Bloomberg Billionaires Index, he's worth about $1.1 billion. That's due to his basketball earnings, plus sponsorships, investments, and his own consumer and entertainment business. And that is your latest Business Flash. Sky.
Thank you very much indeed, Ritika. So it is 23 minutes past 7 on the West Coast. Time for the Startup, where we cover the top tech stories in the Bay Area and beyond. This, the Silicon Valley starts its morning. As you can see, the sun rising over the bridge. Very pretty. Bloomberg's Ed Ludlow, technology co-anchor here at Bloomberg, joins us now. Ed, I'm looking at Google on my screen, Alphabet, and it's down by 6.2%.
Yes.
We have a search problem.
Yeah, so on Monday, Alphabet, the parent company of Google, or Google through its social media platforms, put out a video. And in the video, they were trying to demonstrate Bard, which is their conversational AI effort a la ChatGPT to improve the core Google search. In the video, the question is posed, what new discoveries from the James Webb Space Telescope can I tell my 9-year-old about? One of the bullet point answers is JWST took the very first pictures of a planet outside of our own solar system. The keen-eared of you and space enthusiasts out there will know that's not actually true. The James Webb Telescope was put into commission, deployed at the end of 2021. The first photo of a planet outside of our solar system was taken 2004 by the Very Large Telescope Array in Chile. So the market's 2 days late to this inaccuracy, but it does appear to be selling on the idea that Bard is generating inaccurate responses. I would say that in all of their official communication, Google do describe Bard as an experimental conversational AI tool. So it's an interesting reaction here.
It's an interesting arms race that is certainly beginning, and it's interesting to see how many are getting involved. Baidu certainly getting involved, Microsoft getting involved. Let's talk about Uber. We're going to talk to Dara Khosrowshahi very, very shortly. Back to LeBron James. This looks like a slam dunk. This looks like a great set of numbers here, Ed. Where is the risk? Are we just kind of maybe getting ahead of ourselves and expecting the current trends to continue? I would have thought the consumer would have rolled over by now. It hasn't, and therefore Uber continues to do better.
Yeah, so top line growth of 49% from a year earlier. The comparable is interesting because remember, Uber was facing issues from the end of 2021 around driver shortage, around having to incentivize drivers. The other really important financial metric is by what distance they beat on EBITDA, right? I think EBITDA came in $665 million. The street was looking for around 620. And what they're talking about is they stopped paying bonuses to drivers. And yet, driver availability is at record levels. So they seem to have got the mix right now, and that's showing up financially.
Which is amazing considering what is happening with claims. What about Eats? So Eats continues to do well, which again really surprises me. Anyway, we'll talk about that with Dara. Sorry, I've got my timing wrong here. Ed, great stuff. Thank you very much indeed, Ed Ludlow. So in the next hour, we are going to talk to Dara. He's going to be joining us, the Uber CEO, Dara Khosrowshahi. We're also going to be talking in the next block about BP. We're going to be talking to BP's CEO, Bernard Looney, is going to be joining us. BP, was that a pivot we just got from Bernard Looney? We're going to discuss that next. This is Bloomberg.
Last night, at his State of the Union address, President Biden hit on a wide range of topics, including climate change and the future of the energy market.
Let's face reality. The climate crisis doesn't care if you're in a red or blue state. It's an existential threat. We have an obligation, not to ourselves, but to our children and grandchildren, to confront it. I'm proud of how America, at last, is stepping up to the challenge. We're still going to need oil and gas for a while.
I gotta say, the president perfectly summed up the problems facing oil companies right now, particularly some European majors who've pivoted much more quickly into alternative energy. And joining us for an exclusive interview is Bernard Looney, BP CEO. You got across the pond really quickly. You came to sit with me here in New York.
Thanks for having me.
Thank you very much for joining. So, your stock is up 10% in 2 days. Huge pop, helping leave the FTSE 100 to another record high. Barclays had a note out saying that you are a misunderstood stock. What you did yesterday goes a really long way in fixing that in terms of slowing your pivot away from oil and gas. Do you still feel that you're misunderstood?
Well, I think, Alex, first of all, thanks for having me on. It's great to be here. I think what I liked most about Lydia's note from Barclays was she put a target price of £10
of course you like that the most.
On us, and we traded about £5.30 this morning. So, but look, I think what we did yesterday, just to summarize it briefly, the company's running well. We had our strongest operations in history. We had our lowest production costs since 2006. The strategy is working, so the company's running well. We announced that we're leaning into the strategy. $8 billion more into the energy transition, $8 billion more into oil and gas. And we're returning returns to our shareholders. We announced a 10% dividend increase, and we announced that we'd buy back $2.75 billion worth of shares. So I think the company is running well. We're leaning in. I think investors increasingly understand that. Importantly, they see our track record of performance, which I think is good. And I think that's why you saw the response from the market that you did yesterday.
Okay, so going forward, if you take a look at your EBITDA forecast and the growth, it really feels like to me you need a high oil price to get there. And I know you say 70, but if you inflation adjust for 2021, you're really looking at like 90. Do you really need like a $90 oil price to make this work?
Absolutely not. And we have a requirement as part of our accounting to publish what we think the best estimate for the forward prices is. We think that $70 oil is our best estimate. Who knows what it will be? Importantly, in our strategy, we run our company on a break-even of $40. We don't know what the future price of oil is going to be. Nobody does. And therefore, it's important that we run it conservatively. So we run it with a balance point of $40, such that if prices drop, we can pay our dividend, we can maintain our balance sheet, we can continue to invest. That's what we're focused on. The price will be what the price will be. And if it's higher, clearly, we will do the things that we're doing.
Okay, if it's higher, does that mean that you have to invest more in oil and gas? Because this question came up 3 years ago when we did the panel. You said, no, if oil prices go up, I will not be spending more on oil and gas. Oil prices went up and you're now spending more on oil and gas.
This is driven by a desire to grow our company. We announced yesterday...
This is a free cash flow thing.
This is about growth. This is investing...
But you're not growing volumes, though, are you?
We're investing in the company to grow the company. So we're going to invest in oil and gas. We're going to grow volumes over the coming years. We're investing more into that because people need that today. We need energy security today. We need energy affordability. We must invest in today's energy system. At the same time, we're going to invest in accelerating the energy transition. In 2019, we spent 3% of our capital outside of oil and gas. In 2022, just 3 years later, that number was over 30%, fueled in part, by the way, a huge acquisition here in the United States on a biogas company called Archaea Energy. The world needs us to do both. We believe we can create value for our shareholders in doing so. We're going to stay very disciplined. We've given ourselves a range of $14 to $18 billion of capex per annum, and that's what we're going to do. It's a growth-driven strategy, and that's what we're trying to achieve.
So I appreciate that. But then you take a look at how you're valued versus like an Exxon, for example. The market wants you guys, and I say you, and I say European majors too, to be an oil company. That's why Exxon and Chevron are going to have the multiple that they have versus like a BP. You have the stock up 10% in 2 days. They like the fact that you're an oil company.
They like the fact that we are delivering. We have a track record, 3 years now of delivery, 30% return on average capital employed last year, net debt down for the 11th quarter in a row.
But that's an oil thing.
They like the fact that we're delivering, and they like the fact that we're growing. And yesterday, regardless of oil price, we said that we would grow EBITDA further, $5 to $6 billion, regardless of oil price, beyond what we thought. So what they like is they like the companies working well, they like the strategy, they want growth, and that's what they're rewarding.
If we get to $120 oil, what do you guys do? The market is telling you they like the volume. They want the volume.
We stay disciplined. We're staying disciplined. We absolutely stay disciplined.
You're not levered to the macro in that point.
We absolutely. This has nothing to do with oil price. This is about staying disciplined. We're going to spend between $14 and $18 billion a year. We'll only spend at the upper end of that range if we can meet our returns thresholds. And if we don't, we won't. It's as simple as that, regardless of what the price of oil is going to be. Okay. If it's higher, we'll be buying back more and more shares. We think we can raise the dividend at about 4% per annum at $60. We think we can do about $4 billion per annum of buybacks. We've already bought back 11% of the company's share capital in the last 2 years. So if there's surplus cash, it will go to the balance sheet, it will go to our shareholders. The capital stays disciplined.
Okay, so you're going to stick to the two strategies. I get that. When do you think that the stock then gets valued for both of those businesses? Because you can make an argument that if you look at your market cap, you're not going to get valued for a return of a wind farm at 8%. And I appreciate that biogas would be a 15% return. When do you get credit for that in your valuation?
Well, as always, you've done your research well. So biogas is 15 plus percent, biofuels 15 plus percent, EV charging 15 plus percent, hydrogen double digits. This is not just a renewable story. These are our transition growth engines. Look at what we're doing in biogas. We paid $4 billion for Archaea. We're going to help transform that business. We're capturing methane from landfill sites that would otherwise leak into the atmosphere, damage the atmosphere. We're then processing it. We're burning it. They have an 80-site pipeline. It probably would have taken them 4 years to do that. We can probably do it in a couple of years. These are the things that we're leaning into. They're returns driven. The transition doesn't have to equal low returns. These are high returning businesses. When will the market recognize it? Step by step, day by day, deliver. And I think what you saw yesterday is the market beginning to recognize what we're doing. You can't ignore the numbers. The performance of the company is strong. We are investing into the transition. We're investing into oil and gas. We've got huge resources around the world, including over half of our capital here went into the United States last year. So tremendous opportunities in the Gulf of Mexico, in the Permian Basin. We're going to grow production here, 100,000 barrels a day in the Permian. In the next couple of years, we think, Alex, we can double it by 2030.
So transition doesn't mean lower returns. I get
Correct.
that. For some, like wind farms, okay, but for the biogas, like you said, for example, or hydrogen, it doesn't have to be. It can still be that 15%. If you don't get that, what's the risk that you don't get that? And if that's the case, what do you do with it? And I say this because this is not the first time that an oil company has been in alternatives. You take a look at the last 50 years, Shell, BP, Exxon, for example, have done the alternative energy thing. They couldn't make the kind of juicy returns you get for oil and gas, and then they spin it off. Why would this be different for you now?
We have, as an integrated energy company, which is what our strategy is, enormous advantage in this space. If I take sustainable aviation fuel, if you and I want to start up a sustainable aviation fuel company tomorrow, which is the only way we'll decarbonize.
Totally do that. Yes.
Let's talk about it. The only way that we'll decarbonize aviation, you need to do three things very quickly. One, you need feedstock. Two, you need to build a plant. Three, you need to sell it. All very difficult, especially the first one. We're one of the largest trading businesses in the world. We can do the first part. We build projects for our living. We can build a plant on time, on budget. And we'll want to sell it. You and I will go on Google and find your favorite airline CEO. We're in 700 airports around the world. We're in 70 countries with our aviation business. We have an incredible advantage. Why wouldn't we do that? SAF is high returning. But it's not just doing that, it's investing in today's energy system as well. Investing more into the Gulf of Mexico, more rigs in the GOM, more rigs in the Permian, more rigs in the Haynesville. That's what we need to do. It's an and conversation, Alex, not an or conversation.
So the synergies, right? Biofuel, biogas, you mentioned hydrogen, there's also the convenience charging centers, right? Those seem to be the areas you highlighted that do have the synergies for BP. Can you talk more a little bit about why those and not wind and solar, Or like, what have you learned that makes that the money winner for you guys?
So of the increasing capital that we're announcing in the transition, it is very much going to be focused into the areas that are higher returning. It's also the areas that give customers, people like yourself, corporations, they want help decarbonizing their lives now. We need SAF now. The reason people aren't buying electric cars isn't necessarily because there aren't electric vehicles, it's because there isn't the infrastructure.
But isn't
so
that
we're leaning into that.
But aren't you profitable for you there with convenience stores because I'm buying a cup of coffee when I'm charging my car?
100%. It's a great business, which is why we're doubling down on it. So we're putting more and more money into that. And in offshore wind and solar, we're focusing that investment. We're focusing it on where we can do something with the electron. We want to take the electron that we generate from the wind turbine, Alex, and we want to do something with it. We want to put it into green hydrogen. We want to put it into our own EV charging business. We want to put it into our trading business and our power business, what we do here in the United States. So that's what we're trying to do. We're trying to upgrade the electron, and we believe that we can deliver returns through that.
If you can, are you then an M&A target?
For?
Another company.
It's not something that I worry about. I'm focused on executing the plans that we have laid out. I think what you see yesterday, the response in the market says, this is a company that's running well. We've got 3 years of track record under our belt. They liked the clarity of the strategy. They liked the fact that we're leaning into the strategy. That's what I'm focused on. We've got a job to do. We're going to continue to do it, and that's what we're focused on.
I hear you. They also like the dividend, and they like high oil prices. I mean, I understand that what you're saying, but they also like the other. Let's not. I mean, that's.
Our shareholders own our company, and one of the things we must do, along with investing into the company, is take care of our shareholders. We have bought back 11% of the company in the last 18 to 24 months. We announced a $2.75 billion buyback yesterday. We hiked our dividend 10% yesterday. We think we can grow the dividend at $60 oil at 4%. We think we can buy back $4 billion of shares at $60. So we're very focused on our shareholders. They are the people that own the company, and they must get the return that they deserve.
Okay, I'm going to make you happy and go to macro for a second so you can breathe a sigh of relief. For China reopening, what are you guys noticing in terms of demand? Sporadic? Do you think it's going to come back strong? What do you see?
There's every potential that China will come back strong, in that it is coming back strong. I think a lot of the data that we're seeing, and you probably have access to a lot of it, says that China has moved through the wave probably already, or at least a lot faster than what people were projecting. There is this, we all experience this pent-up demand, and I think you're seeing that if you look at any of the mobility data, restaurant booking data, flights within China. There's every reason to believe that China is going to come back strong.
We've had Russian bans for product as well as oil flow. What have you guys noticed in terms of shipping, how the world is moving stuff around differently, and where the demand pulls are coming from that's different from a couple years ago?
It's the world is rewiring the energy system, and that's why we've seen...
Is it making it less efficient from where you sit?
It's different, and you know, we've had infrastructure that's in place for a long time. Gas used to flow from Russia through pipeline into Europe. It doesn't do that anymore. So the oil and the energy system is being remapped. I think it is amazing how quickly it has remapped itself, but that's what's happening.
I'm wondering if that's going to make, though, energy just more expensive on a structural basis.
Look, any one of us who tries to get into the art of predicting, we don't know. But what I can tell you is that stocks are at, if I look at oil, stocks are at historically low levels. Spare capacity is quite tight in the market, about 1.5 million barrels a day. Iran is producing a lot. Venezuela is doing what it can. Libya is producing a lot. Demand is robust. We think we'll be up over 2019 levels this year. Yes, there will be supply, but after that, if you have a disruption as demand continues to grow, it could get very, very tight.
From a gas point of view, do you think the European gas crisis is over right now, or do you think it comes back in the summer and next winter?
I think the warm weather has helped dampen prices in Europe, but I think we have a lot of work to do. The system is still fundamentally short of LNG, so I think the warm weather has helped dampen prices today, but it hasn't solved the problem.
So to that point, not solving the problem, what do governments say to you right now? So does President Biden pick up the phone and say, hey, Bernard, you got to pump more stuff right now?
So I think governments around the world are more conscious than ever that we must solve the energy trilemma. Yes, we need cleaner energy, but we also need energy that's secure, and we need energy that's affordable. That's our strategy. Our strategy is to do that, is to help solve that. But governments, to your question, are asking companies like ours from all around the world to invest in governments all around the world.
Okay.
All around the world. You only have to look at countries in Europe traveling to Africa, traveling to the Middle East, searching for gas supplies. They want more investment in today's energy system, and, not or, they want to accelerate the energy transition. That's our job. And yesterday we announced we're going to do more of each, and the market liked it.
Good salesman sometimes, Bernard. Thank you very much. I appreciate you giving me so much of your time.
No, thank you for having me on. I really appreciate it.
And it's all about the weather, guy. All right, Bernard Looney, BP CEO, thank you very much. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. Ukraine's President Volodymyr Zelensky made a surprise trip to London, where he spoke to British lawmakers and met with Prime Minister Rishi Sunak. Zelensky praised the UK for backing Ukraine since the start of the war. Later today, he's going to Paris to meet with the leaders of France and Germany. The death toll from those earthquakes in Turkey and Syria has now risen above 11,000. Thousands more are trapped inside buildings that collapsed. Turkish President Recep Tayyip Erdogan visited the disaster zone today. Meanwhile, Turkey's stock exchange has suspended trading for the first time in 24 years, a sell-off after those two quakes raised $35 billion in value from its main equity gauges. Trading will resume on February the 15th. Global News powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, guys.
Ritika, thank you very much indeed. Let's continue to talk about the impacts of those quakes. Beryl Akman, Turkey economy and government reporter, joining us now from Ankara. Beryl, thank you very much indeed for taking the time to speak with us. Clearly, this is a country that is experiencing a huge trauma. The closing of the stock exchange, though, is that an indication that the government feels that the situation is out of control? We haven't seen that for 24 years. What signals should I take away from that, and what else we're getting from the government?
President Erdogan, speaking today in one of the quake zones, has indicated that the government has taken everything under control, and he was very calm but recognized the scale of this quake and disaster, which he has described as the biggest disaster not just in Turkey in the last century but in the world. Investors and fund managers had been calling for the stock exchange trading to be suspended in the last few days, as it had triggered a steep decline and a panic selling in memories of a 1999 earthquake that was also very powerful, and at that time trading had been suspended immediately, so investors brought that up and had been calling for this, so it was expected.
The pictures are truly staggering. How do we get back to some kind of normal from an investor base, from an economic base?
I mean, this is a massive, massive earthquake. The death toll just in Turkey has surpassed 9,000. So recovering from this will take time. President Erdogan has vowed that he will rebuild all the buildings within a year. But Turkey is also is slated for elections in May, and there's no indication that the state will change right now, and that will likely determine, what's going to happen in the coming months as well. If the government resumes and maintains power in those elections, then the outlook for the next year could be different than if the opposition were to be elected to power. But Bloomberg Economics estimates that disaster-related spending, including rebuilding efforts, might make up 5.5% of the GDP. President Erdogan has declared a state of emergency, meaning that he will direct all financial sources and public resources to the quake zone first.
All right, Beryl, thank you so much. Stay safe. Thank you for the update, Beryl. Akman joining us from Ankara. This is Bloomberg.
35 minutes to the European close. Let's talk about what is happening with European equities. First of all, we're up by around 0.4%. Energy stocks, well, actually one stock. Energy is really leading. BP is doing a lot of the heavy lifting, but you've got Equinor up today as well. You've got a whole handful of other stocks doing fairly well as too, but nevertheless BP is lifting the FTSE 100 back into fresh record territory. We heard from Bernard Looney just a few minutes ago speaking with Alex. So the Stock 600 just shy of 460 right now. We're up by 1.7 points. What we do continue to see is the sell-off in bonds. So this is the German 10-year now, 2.373 is where we are tracking. The hawkish commentary from the ECB continues. It continues from the Fed as well. But Klaus Knott is the latest, continuing the theme basically that we've seen over the last few days. So yields continuing to push a little bit higher. What I do think this week is about, though, from a European perspective, is earnings. Today we get SocGen. The stock basically down on the back of the fact that the company has decided that it is not going to continue with the 50% payout ratio that has been a central pillar to the bank's investment case. But the problem is, though, that if they had done that, I suspect that the regulators would have had an issue. Tomorrow we get Credit Suisse. Tomorrow we get Crédit Agricole. Tomorrow's a huge day for European earnings. Today was big. I think tomorrow's even bigger. We get AstraZeneca out tomorrow. There's a whole range of companies you want to pay attention to. L'Oreal. All of these companies are going to be out. So there is a bottom-up kind of element to this market as well. How are we doing on the earnings story is a factor that we need to think about. The other thing we need to think about as well is that Volodymyr Zelensky's been in London today. Do we need to refocus on that Ukrainian risk ahead of the big kind of push from the Russians that everybody thinks is coming? We're going to discuss that next. Gareth McCartney of UBS, he's the global co-head of equity capital markets, is going to be joining it. We'll get his take on all of those questions next. The close is coming up. This is Bloomberg. Wednesday, the 8th of February. European stocks rolling over a little bit into the close, but we're still up by 0.4%. Energy stocks are doing much of the heavy lifting today. It is a day of earnings news. Tomorrow is even bigger, but that is the narrative right now. Plus, we need to fold in a little bit of geopolitics. We're going to do that over the next hour. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So we're trading 460 on the Stoxx 600 coming into the close. We're up by around 0.4%. Quite a big separation in terms of the sector story today. Energy definitely positioned right up at the top. We've already talked about BP. Let's talk about some of the other stocks we're watching here as well. The Norwegian market outperforming Equinor. The reason for that outperformance is the payout. Much higher than anticipated from Equinor. That stock up by 6.85%. European energy stocks have not had a great start to the year. The last couple of days has really changed that in terms of their form year to date. It's not all plain sailing for European equities though. Aiden is an interesting stock. This is a payments company. It deals with Uber. We're going to talk to Uber a little bit later on in this hour. It deals with H&M. It provides payment services for those kinds of businesses. The rest of the industry in some ways is pulling back a little bit at the moment, pulling back on things like hiring. This company is not, and as a result of which you are seeing a margin squeeze, and the market doesn't like it. As you can see, that stock tracking lower by around 15%, 16% right now. It's a day of single stocks, I would argue. Yes, there's a macro theme. Yes, there's a geopolitical theme, but earnings are front and center, Alex.
I'll see you and raise you one here. You got the S&P down by 0.8%, but that, as you point out, is really a single stock story. The Nasdaq 100 up by 1.4, and the reason is Alphabet. These are the A shares. They're down 8%, but if you put the two shares together, you're looking at almost 80 points off the Nasdaq 100 due to Google and their ChatGPT system Bard maybe not having the results that the market really wanted, inconsistencies potentially. Plus, overall, you got Microsoft, you got Alphabet. They're all competing in this new AI space. If you take a look at the macro, that's where the 2-year comes in. You had Lisa Cook, you had John Williams, all continuing to talk about this hawkish rhetoric and still need to do a lot more to bring inflation down. And the 2-year literally does nothing, 4.46%. Google's in charge, everything else on hold, Guy.
It's amazing, isn't it? Just the impact that that single stock is having. Let's get to the geopolitical angle on what we're watching here. The Ukrainian president, Volodymyr Zelensky, making a surprise visit to the UK today, just as Prime Minister Rishi Sunak announced more training for Ukrainian troops and new help to train fighter jet pilots. Maybe a precursor. Zelensky spoke at Westminster Hall earlier today.
London has stood with Kyiv since day one. From the first seconds and minutes of the full-scale war, Great Britain, you extended your helping hand when the world had not yet come to understand how to react.
Zelensky addressing parliamentarians a little bit earlier on in London. Alex, let's go to Brussels now. Let's talk a little bit about the context around this trip. We're joined by Bloomberg's Ros Matheson. Ros, what is the objective for Zelensky here?
Well, clearly what he's wanting to do as this war approaches the 1-year mark in just a couple of weeks is to keep momentum going in terms of support from the West, and that means two things, money and weapons. And certainly the trip to the UK today was very much about that. That's a country that has actively supported Ukraine throughout, sending a lot of weaponry and financial aid alongside other countries and Europe. And then he goes on to Paris this evening, of course, to meet with Emmanuel Macron and Olaf Scholz. And this is all about saying, don't forget that we're still fighting a war here, and in fact we still need much more in the way of longer range weaponry than you're sending. So you see again the plea for things like fighter jets coming in, and it's all about saying, you know, we're facing particularly dark weeks here in Ukraine. There's every expectation that Russia is gearing up for an offensive very soon. They still need these weapons coming in, and it's all about saying we need to have this still coming in.
How does this eventually wind up playing out? What can we expect over the next few months in terms of how Ukraine can handle any offensive from Russia?
Well, that is the big question because, of course, there's every sign that Russia is massing for an offensive in the east and the southeast very soon, and they could actually, gain some territory out of that, whereas Ukraine is on a slightly different timeline because they can't really do their own offensive to try and retake territory, particularly in the south, until they have these tanks that have been promised, until they have new weapons, and that's probably some months away. So what they really need to do at the moment is try to hold Russia back, perhaps, as US officials were telling us recently, stall for time essentially until these weapons come in. So we're sort of looking at a couple of really rough weeks, if not months, for Ukraine to sort of sustain that momentum on the ground, and that's really what the President Zelensky was talking about today when he was addressing the British Parliament.
That doesn't sound good. Hope it goes away. Ros, he was presented with a fighter pilot helmet. The UK is suggesting maybe that fighter aircraft could be made available. Others are much more nervous about that step. Is this, though, is this start of a process that ultimately takes us in that direction? We were worried about delivering tanks. We're now delivering tanks. The UK does seem to be out in front in terms of allowing weapons to be transferred into the Ukrainian theatre.
Well, that's the interesting thing because, of course, all the things that months ago were off the table, some of them have become on the table and now being sent to Ukraine. But even so, the UK remains very cautious about committing modern Western fighter jets for Ukraine. You can see that even in the language today. They're saying we'll make an assessment in the longer term about potentially doing this. Right now, they've made clear they've got no intention, like Germany, the US, also sending in modern fighter jets at this point in time.
How united, Roz, is the rest of Europe with the UK and the US on sending support to Ukraine? And is the public support also holding up here?
Well, certainly you do see that strong sense of unity this close to the one-year mark of Russia's invasion of Ukraine. But as time goes on, naturally that question will arise further. You saw a lot of disagreement about sending tanks. That discussion went on for weeks. And even now we're seeing European nations not committing a direct timeline to doing that. So the natural question becomes, as time goes on, where does that leave that unity? You do see some public polling in France, in the US, for example, suggesting that fatigue is really starting to creep in.
Ros, the market for the time being appears to have parked the issue of Ukraine. It obviously had a huge impact when the war started. That has faded. What kind of timeline are we now looking for the resumption of serious hostilities, the push that we're all waiting for? When do we think that's going to come?
Well, the assessments that we've seen, that we've reported on the past week, suggest that something from Russia could be imminent. They're massing troops in the east, in the southeast, and the terrain is improving in terms of their ability to move their heavier equipment around. And they know that the sooner they act, the better, because at some point these tanks, these other weapons will come in for Ukraine, which will give Kiev a much better advantage. So for Russia, the window really is now, and those reports from Western officials are suggesting it could be imminent, again, in the eastern and the southeastern areas, certainly not coming in again from the north.
All right, Roz, thanks a lot. Really appreciate you joining us. Bloomberg's Roz Matheson joining us. And President Zelensky and Prime Minister Rishi Sunak will be holding a news conference sometime in the next hour, and we'll be bringing that to you. Coming up, are investors underpricing Ukrainian risk? We're going to talk to Gareth McCartney, Global Co-Head of Equity Capital Markets over at UBS. We have a nice rally underway. The FTSE 100, another record high. We'll break it down. This is Bloomberg.